We've been sold a singular story, the white picket fence as a retirement account. It was a brilliant machine that turned cities into growth engines. But today, the gates are locked. Affordability has vanished, and the traditional path to ownership is broken. It's time to stop waiting for a system that isn't built for you and start building something else. Option 1. House hacking. This is the most accessible option on this list, and it is the one most people have never seriously considered. House hacking is simple. You buy a property, you live in part of it, and you rent out the rest. That rental income covers your mortgage. In some cases, it covers it entirely. The most common version is a duplex. You live in one unit, a tenant lives in the other. Their rent pays your mortgage. You are essentially living for free while building equity in an asset. In some markets, a well-chosen duplex means your housing cost drops to zero, but it does not have to be a duplex. A single-family home with a basement apartment works. A property with a detached garage that can be converted to a studio works. Even renting out spare bedrooms works, though that comes with its own trade-offs. Here is why this matters in the current market. The biggest barrier to home ownership right now is not the down payment. It is the monthly payment. A $400,000 home at 7% interest costs over $2,600 a month before taxes and insurance. Most people cannot absorb that, but if a tenant is covering $1,400 of that, suddenly the numbers change. FHA loans allow you to buy a multi-unit property with as little as 3.5% down, as long as you live in one of the units. That is the entry point. You are not a landlord playing investor with other people's money. You are a resident owner making a calculated financial decision. The catch is that you need to buy in a market where the rental income actually pencils out. That requires research. It requires patience. But it is real. It is happening. And it is one of the few remaining paths into ownership that does not require you to already be wealthy. Option 2. Co-ownership. Homeownership used to be a solo sport, or at most a couple's game. That assumption is worth questioning. Co-ownership means buying a property with someone you are not married to and not romantically involved with. A sibling, a close friend, a colleague, two families going in together on a larger property. The structure varies. The principle is the same. You split the cost, you share the asset, and you get into the market at a price point neither of you could reach alone. This is not a new idea. It is actually how a lot of property was purchased before the post-war era of single-family suburban homeownership became the default. It fell out of fashion because mortgages got cheaper, and the suburban dream sold people on the idea of a house as a private castle. Now that mortgages are expensive again, the logic of shared ownership is coming back fast. There are legal frameworks for this. A tenancy and common agreement spells out ownership percentages, exit strategies, what happens if one party wants to sell, and how decisions get made. You need a good attorney to draft it. That costs money up front. It saves enormous grief later. The psychological barrier is real. People worry about mixing money and friendship. That is a legitimate concern. It is also manageable with the right legal structure and honest conversations before any money changes hands. The question is not whether co-ownership is risky. Everything in housing is risky right now. The question is whether the risk of co-ownership is greater than the risk of being permanently priced out. For a growing number of Americans, it is not. Option 3. Rural relocation and raw land. This one requires the most honest conversation about what you actually want from your life. There is still cheap land in America, not in the cities, not in the suburbs. But if you are willing to move, genuinely move, not commute from 2 hours away, but actually restructure your life around a different geography, you can still buy land at prices that make sense on a normal income. In parts of Appalachia, the Ozarks, rural Texas, the high desert of New Mexico, the upper Midwest, you can buy multiple acres for what a parking space costs in San Francisco. We are not talking about plots in the middle of nowhere with no services. We are talking about land within reasonable distance of small towns with schools, hospitals, and broadband. The raw land strategy works like this. You buy the land first, often with cash or a short-term land loan, because conventional mortgages do not cover empty lots. You live cheaply elsewhere while you plan. Then you build incrementally, owner-builder style, adding to the structure as money allows. No $600,000 mortgage, no 30 years of debt. A slower build, but one you own outright at every stage. This is not for everyone. Remote living has real trade-offs. Career options narrow. Social networks require more effort to maintain. If you have children, school quality varies significantly. These are not small things. But if your current city is consuming 40%, 50%, 60% of your income in rent, and you have a job that can be done remotely, the calculation is worth running. Seriously running, with real numbers. A lot of people discover that what they thought was impossible is actually just unfamiliar. Option 4. The rent and invest strategy. This is the most misunderstood option on this list because it requires you to let go of a belief that most Americans hold almost religiously. The belief that renting is throwing money away. It is not. Renting is paying for housing. Owning is paying for housing, plus maintenance, plus property taxes, plus interest, plus the opportunity cost of a large down payment sitting in an illiquid asset. In many markets right now, renting is the financially superior choice, but only if, and this is the critical part, you actually invest the difference. Here is the logic. If you would spend $3,000 a month on a mortgage, but your equivalent rental costs $2,000 a month, that $1,000 difference invested consistently in a low-cost index fund over 20 years becomes a significant sum. Historically, the stock market has outperformed residential real estate in most markets over most long time periods, with better liquidity and far lower transaction costs. The problem is that most renters do not invest the difference. They spend it, which is why the discipline required to make this strategy work is the reason most people never execute it properly. This is not an argument against ever buying. It is an argument against buying badly. Buying in a market that does not make financial sense. Buying at the top of your budget, because that is what the bank will approve. Buying because society tells you that ownership is the finish line, and renting means you failed. In the right circumstances, with the right discipline, staying a renter and building wealth through investing is a completely legitimate path. The shame attached to it is a cultural artifact from a time when home prices rose reliably and mortgage rates were low. That time is gone. Option 5. International relocation. This is the one that makes people the most uncomfortable, and it is also the one that the numbers make the strongest case for. The housing crisis is an American problem. It is also a British problem, an Australian problem, a Canadian problem, but it is not a universal problem. There are countries where a middle-class income still buys you a real life, where the maths of housing still works, where you are not spending half your waking hours working to pay for the roof over your head. Portugal, Mexico, Colombia, parts of Southeast Asia, parts of Central America, New Zealand outside the major cities. These are places where Americans with remote income, a pension, Social Security, or a modest savings base can own property and live well at a fraction of the cost. This is not a fantasy. The number of Americans living abroad has grown significantly over the past decade, and it accelerated after 2020, when remote work broke the link between location and income for millions of people. Digital nomad visas now exist in over 50 countries, specifically designed to attract remote workers. The trade-offs are real. You leave your community, your family proximity, your familiar systems. Healthcare, legal structures, and language barriers are genuine considerations. This is not a decision to make lightly or quickly. But here is the reframe. You are already making trade-offs. You are trading time, health, relationships, and financial security to stay in a market that is actively excluding you. The question is not whether you make trade-offs. You are already making them. The question is whether the trade-offs you are making right now are actually worth it. The housing crisis is real. The pain is real. But the story that there is only one path, that you must wait, must save, must compete in a broken market on the market's own terms, that story is not true. That is 5 unconventional ways to bypass a broken market. Whether you move, build, or invest, none of these options require waiting for a system that isn't built for you. Which one of these 5 paths actually makes sense for your life? Realistic or just a pipe dream? Let me know in the comments below. And remember, we all deserve an affordable home.